The last video was about credit cards. This video is going to be about all types of loans. As I mentioned before, with a credit card, if you don't know when you're going to be able to pay it off, then it might be worth getting a personal loan. Now, a personal loan, what you do is it's an unsecured loan, so it's not connected to anything. You don't have to connect it to any type of collateral, i.e. any type of asset. Also, it has a fixed term, so sometimes you can have the loan for 5 years, 3 years, 1 year, a year, 2 years, whatever you want. When you actually agree the term and you agree the amount that you want to borrow and the purpose for borrowing it, and they also look at your credit score, all of those will play a part in what interest rate they offer you. That interest rate will be fixed for the whole term of the personal loan, which is good because unlike a credit card, which the interest rates can move and fluctuate, over the term you will know exactly what you're paying per month, and then you know as long as you make those payments on time every month for the entire term, then you'll have paid off the loan at the end of it. Unlike with some credit cards, unfortunately, you're making the minimum payment month after month after month, and after several years you've still got the same amount outstanding. So that is that. The way a personal loan works is you've got the principal amount. So for example, you borrowed £10,000, then you've got the interest. They'll calculate how much interest you pay based on the £10,000 you borrowed times that interest rate times the amount of time that you've got it for. So it may be 60 payments, i.e. a 5-year mortgage, because it's 5 years times the 12 months, which will be the 60 monthly payments. So they will have the interest there as well. Now, what you can sometimes do with some lenders is pay off early, and that they will also include some of the interest, if not all of the interest, as a penalty of paying off early. But that's something we can talk about later. The next thing I'd like to talk to you about are secured loans. Now, the difference between a credit card or a personal loan is they're unsecured, they're not linked to anything. A secured loan is secured against something, which means the positive, because it's secured against something, it's less risky for the banks to lend to you. So the interest rate probably will be a lot lower than a personal loan. But on the other side of things, the fact that if it is linked to something, so an example of this would be car finance or a mortgage where it's linked to the car or the property, and because it is secured against something, if you miss payments or if you're unable to pay, you can lose what it's secured to. So that's something to bear in mind. Yes, it will also be closed, i.e. it will have a term, so a fixed end date, and it will have an interest rate that is either fixed for the entire period, depending on the type of secured loan, and it will also be linked to something which is called, it will have collateral, which, and we've all heard of collateral damage, haven't we? So that's something to sort of bear in mind, pros and cons. The next type of loan is a bad credit loan. Now, with a bad credit loan, they will have a higher rate of interest than an average personal loan because you have bad credit. So there are a lot of companies out there nowadays that will lend no matter how bad your credit is, but you just have to really read the fine print and understand what the interest rate is and what the ramifications are against your credit score, for example, against your credit report if you miss any payments, and how the interest rate is affected, basically. Another type of loan is a guarantored loan. Now, with a guarantored loan, it means that someone is guaranteeing that if you can't pay, they'll pay instead of you. So that's something else to look at. Then you've got peer-to-peer loans or friends loans. So sometimes, depending on what you need it for and how long you need it for, maybe you consider asking a friend to lend you the money. So you've got that type of loan. Then you've got your student loan. Now, with student loans, this is normally linked to a degree or some kind of, it's not normally higher higher education as a point of secondary, because that's normally done by the state, so it is included in, you know, council tax and things like that. So I mean, in the UK we do get a free education, which is great up to the age of 18, but once you're over 18 and you want to do, you know, a university degree or a master's or a doctorate or anything along those lines, then you would probably apply for a student loan. And with that, they will look at your finances and consider whether they should lend it to you or not, and that kind of thing. So bear that in mind. Also, depending on what university you go to, you might be able to get a grant or a scholarship or something like that. So that actually reduces the loan. If you got a grant or a scholarship, you may not have to pay those back. With the student loan, the likelihood is that there is something you will have to pay back. The next thing is, you know, there's buy now, pay later. Now, a lot of people don't realise that this is a credit commitment, and I'm afraid it is. It will appear on your credit report, and what it basically is you can buy something now and pay for it later on down the line. So you may start making monthly instalments a month down the line after you've purchased it, or a couple of months down the line, or it may be pay the whole thing next year or in 2 years' time, something like that. But again, please read the small print and please understand buy now, pay later is a credit commitment, and it will be on your credit report, just like all of these other loans. The only type of loan that I've mentioned so far that won't appear on your credit report is if you borrowed off a friend or a student loan. A student loan can affect a mortgage application, just so you're aware. They will ask that information, but it doesn't appear on your credit report. If you've got any questions around that, please feel free to put a note in the comments. If you're finding this video interesting, please subscribe, press that notification bell, and then that way, as my more and more videos come out, when they do come out, you'll be aware of them and you'll be able to watch them straight away. Another type of loan is a pawn shop loan, and the way the pawn shop works is you have something of value, you take it into the pawn shop, they take it from you, they give you like an IOU for either the value of the property or the value of the item or half the value of the item, and what you need to do is keep that for whatever length of time it is, and then once you've actually got that money, you can then pay what they've said that's on the slip. Sometimes they charge interest, sometimes they're not. Again, check the details of this, and then you can actually get your item back. It is a little bit of a time limit thing. Sometimes if you take too long to come back to them, they could have sold your item, but generally speaking, as long as you come back within the time that was agreed, you should be able to get your item back. The next type of loan that I wanted to talk about is an employee loan or a season ticket loan. Now, the way this works is, as I've said, it is an employee loan. So you have got to be an employee. And what this will do, it's quite good actually, if your company and you've been working there a certain length of time and they offer this. And as I said, they sometimes offer it for several different reasons. The main reason I've seen them do it is for a season ticket loan. So at the beginning of the year, it's a lot cheaper to buy your travel card for the whole year rather than buy it per month. But that obviously can be several £1,000s, especially if you're you know, in London and traveling, you know, up to zone 6 or even further than that. So what they'll do is they'll offer you a season ticket loan. So the company will pay for the ticket on your behalf, or they'll give you a check so you can pay for the ticket, or they'll give you a check for whatever the reason you guys have agreed with your employer why you'd be borrowing that money. And then their agreement normally is they will literally take the money out of your pay slip. So every single month, this money will be deducted. But putting my accountancy hat on, it is the reason why I think it's quite good, is because the way it works is the money is deducted before tax. So you actually get that tax advantage. So you'd get your normal salary, and then they deduct, you know, all the normal things like pension, etc. Then they'll also deduct this season ticket loan or employee loan, and then they'll be calculating the tax after that. So you actually end up paying less tax, which is also a bonus, rather than and I will do a video on pay slips and how to calculate pay slips and how it's accurate and what kind of deductions there are. But it is beneficial that you get taxed after the deduction, because then you're paying less tax because it's a lower amount than vice versa. You can also have loans for businesses. So a business loan, they normally would like a business plan. And if, again, put it in the comments if you would like me to go through how a business plan works. But essentially, you put down, what your plan is for your business, and if they like that plan, and you also have to put in some financials as well. So that will normally be, what your projection is of paying back the original loan, what your sales levels, and it's all projected, will be over the next sort of say 5 years, and then based on that they could possibly lend you some money. Now, when it comes to business loans, you could go to the council, you could go to the government, you could shop online. There are a lot of companies that offer business loans, but they may ask for collateral. So if it's a startup business that hasn't been trading, they may ask for some kind of collateral, like your house or a building or something that you own of value. If you have been running for a while, then they'll want to see, your trading accounts, maybe a couple of years of accounts to show that you are profitable. And, you'll need to explain, as I said in the business plan, why you need this money. Is it for an expansion? How are you going to pay it back? What's the time scale you plan to pay it back, and all that other stuff. Right, the next type of loan I like to talk about is mortgages. There is a whole video, or I've got several videos on my channel about mortgages in detail, but I'll just explain it briefly for you. So a mortgage is basically a loan in order to buy a property. Now, there are several types of mortgages you can get. You can get a buy-to-let, which is when you're buying an investment property and you're going to be renting it out. You can have a residential mortgage, which is when you're buying your own home. Now, if you've already got a mortgage and you're doing a remortgage, that is, the mortgage is coming to an end and you're remortgaging, or you want to remortgage because you want to get some additional borrowing, then the additional borrowing is split up into several different categories. One of them would be home improvements. So this is when you're borrowing on your property. So you've got your original mortgage, which you took out to buy the property, and then you've got another mortgage, so a second charge they would call it, or additional borrowing depending on who you borrow it from, for home improvements. Another thing could be consolidating debt consolidation loan. Now, this is quite good because, as I said, mortgages, because they're a secured loan, they will be in a lower rate than a normal personal loan. The only thing you need to sort of do the maths is when it actually comes to the term, because you could have a personal loan for say 10%, but it's only for 2 years, and then you could have a mortgage for say 5%, but it's 25 years. 25 years of 5% is a lot more than your personal loan, which is a higher percentage, but it's for a shorter amount of time. So you just need to or ask your mortgage broker to actually look at the cost effectiveness of it, and any good mortgage broker should do that for you. Another type of loan, which is also around property, is called a bridging loan. Now, the bridging loan is if you're in a situation where you're trying to sell your property to buy another one, so you're in a chain, but you don't want to lose out on the new property, and your current property either hasn't sold yet or hasn't completed yet. And again, I've got a lot of videos to talk around the buying process and how it all works, to bridge that gap between, because what you do is you'd sell your property, use that money to pay for the new property. If you haven't sold your property but you need to buy the new property because they won't wait for whatever reason, then you can have a bridging loan. Now, this is normally for less than a year. The interest rate is a lot higher than a standard mortgage, but it does bridge the gap. It's a bridging loan, it bridges the gap, so it fills that gap. So it literally just works out, and it's one of the other ones, the maximum is normally 12 months, but depending on when you sell your existing property to pay it off, it could be only 6 months. So at the time of doing the application, you're going to know the exact length, but you go with worst case scenario 12 months. But normally properties, will complete within a shorter period than a year, fingers crossed. And those are all the different types of loans. Obviously, that's not an exhaustive list. There are others like payday loans and things like that, and they are also a very high interest, and they're also like a type of bridging loan, but between payday to payday. So I'm hoping that that's all been, you've understood everything, and at the end of the day, when you're looking at which of these loans suits you best, the things to consider are how much do you want to borrow. For example, if you're buying a property, the likelihood is you're going to want to borrow quite, hundreds of thousands of pounds possibly. So that's something to look at. What's the cost of the loan? Sometimes, as I said, if you've got a credit card and it's interest free for like 12 months and you're only going to need the money for a few months, then it might be worth using a credit card to subsidize whatever you're working on. If it's going to be longer than that and you want to know what you're paying every month and guarantee that it's paid off, then you may want a personal loan. So it really does depend. When it says about what you need it for. So if you need it to buy a property, then a mortgage is going to be the one for you. If you need it to buy a car or a motorcycle or something like that, then, car finance or loan finance is also for you. If you're planning to, for example, buy a car that's a little bit older, you may want to go with a personal loan. If you're buying a brand new car or from a dealership, they will offer their own car finance. So it's also worth looking at that. But again, do shop around. There are plenty of websites nowadays that you can go on and you can really sort of look at the different items and what you can do. Also consider how long you want the loan for, when you'll be able to pay it back, how you'll be able to pay it back. It's all very well, borrowing money, but you need to factor it in when you're actually looking at your, your tracker or your budget or however you run your finance in your own place. The other thing to look at is whether you want a secured or unsecured loan. Obviously, they both have pros and cons, which I've mentioned to you before. Also, look at how much can you afford to pay off per month. It's all very well saying, I need X amount of money. But then when you look, what term do you want it over? Depending on, how much you can afford per month, you might have a longer term than you initially would like. But at the end of the day, you need to be sure that you can pay it off. The next thing is, are you eligible for a loan? So some loans you have to be over 18, some you have to be over 21. You really do need to sort of look into it, get to the nitty gritty and completely understand it, because worst case scenario, you can't pay these loans and it does affect your credit. And then once it affects your credit report, it will also affect your credit score. You could become credit impaired, and then in that scenario, any future borrowing will be at a much higher rate, or not at all. You'll have a lot of trouble doing that. So I hope that's all been really, really useful for you. And if you've got any questions, please feel free to let me know. Thank you.